the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Business Standard Banking Show. I'm Ishan Gera. In this episode, we will discuss the week's significant developments with a cover story highlighting why the Nifty Bank Index has fallen in recent days despite banks witnessing their best performance ever. We have an interview with S Krishnan, MD and CEO of Tamilnad Mercantile Bank on the bank's performance in the third quarter. In our Banking for You section, experts explain how a 5-day work week affects banking. And our banking expert Tamal Bandyopadhyay discusses budget-related announcements. At the end of the episode, we shall announce the results of the last week's poll and ask you the question for the next one. Last week, the Reserve Bank of India announced a discussion paper on securitizing the stressed assets framework. The central bank also released a report on the performance of urban cooperative banks. However, the week's highlight has been the falling value of the Nifty Bank Index in recent days. Our experts highlight the reasons and the way forward in our cover story. The banking sector delivered stellar performance for the third quarter of 22-23. However, problems have started to show. A look at the Nifty Bank Index would indicate this problem as well. Over the last week, the value of Nifty Bank Index has fallen 5% from 42,821.25 to 40,730.15. It has averaged over 40,000 levels since September from around 38,000 a year ago. The average value was just above 30,000 in the pre-pandemic period. The fall has come despite the fact that net profit for the industry has grown upwards of 30%. So why then are bank stocks falling? We talked to an expert to understand.
So, after a strong rally in the past year for the Bank Nifty, the start of this year has not been the best for the banks. And there are several reasons for this. One, as you rightly mentioned, about the pressure on net interest margin. So now we need to understand that the fundamental reason why there is a pressure on net interest margin is because the deposit growth for the banks in the past couple of quarters has been lagging the credit growth. So the pressure on NIM, I believe, has just started and it could be more severe going forward. Secondly, what is happening because of the slowdown in deposit growth is that a lot of the banks, in order to increase their deposits, they're relying a lot on bulk deposits over retail deposits. So due to this, we have witnessed in Q3 that the CASA ratio of most of the banks have fallen. I believe the biggest fear for the market currently is that if the deposit growth fails to gain momentum going forward as well, the loan growth could come under question, and we don't want that to happen.
Another factor is that over the last year, credit growth has registered a stellar 16.5% increase, but deposit growth has lagged at 10.6% as per data available till January 13th. This credit-deposit mismatch is forcing banks to raise deposit rates, putting pressure on their margins. The pickup in the deposits has already started happening. Deposit growth was 9.2% for the period until December 30. The other option for banks is to dilute their GSEC holdings and advance loan growth. But as government borrowing grows, even that may not be possible. Is the pain likely to continue in the coming quarters, and will banks see worse performance? Our expert answers.
Banks have seen the corporate deleveraging, and that was used to be kind of overhang in terms of the higher gross NPA and net NPA. And we have seen for across the banks, the gross NPA and net NPA has fallen. So therefore, we will see a lower provisioning, which is called a credit cost for banks, will come down. So there could be some pressure on the margins, the top line, but at the same time, we will see lower provisioning requirements, and therefore that will more than offset the kind of a pressure on the NII front.
The transition of deposit rates is slower than the transmission in loans. Media reports suggest that even though net profits for banks were high in the third quarter, the CASA ratio, or the current account saving accounts ratio, for most banks was a problem. This is something that needs to be addressed. As credit growth slows and deposit rates rise, there will be pressure on the net interest margins. Banks will need to be careful in their approach and look for other means. Rising deposit rates and a deposit war, as many are calling it, are expected to put pressure on bank margins. The third quarter performance has still been better. Net profit for Tamilnad Mercantile Bank, which is a private sector bank, was up 38% in the third quarter. Our banking editor, Manojit Saha, had a chat with S Krishnan, MD and CEO of Tamilnad Mercantile Bank, on its third quarter performance and the road ahead.
Welcome to the Business Standard Banking Show. Tamilnad Mercantile Bank is an old generation private sector bank based in Tuticorin. The branches of the bank are mostly based in Tamil Nadu. Today we have S Krishnan, the MD and CEO of the bank, with us to talk about the Q3 earnings and the future roadmap. Mr. Krishnan, welcome to the show.
Thank you very much.
Before I come to the numbers, if you can give us an update on the chairman appointment. In September last year, RBI rejected the name proposed by the bank. Has the bank made fresh suggestions?
No, the bank is in the process. The bank is in the process of making a fresh suggestion. So we will be letting know as and when we finalize and also the RBI approves that. Nevertheless, that is not a big one because it is a part-time non-executive chairman. The board is a fully professional board representing the different disciplines. We have chartered accountants, we have company secretary, we have IITians, we have business magnates, and besides that, as the MD and CEO, you know that I am also coming with a rich experience in the banking field. So right. The part-time non-executive chairman post is not a big issue.
Now coming to the Q3 numbers, the advances growth were about 8.8% year-on-year, which is way below the industry growth rates. Are you being cautious or conservative?
If you look into the total advance growth, you will feel that yes, it is true. I am grown only little less than 9%, which may lead to infer that I am cautious or careful. But let me tell that basically the bank is focusing on the RAM segment. On the RAM segment, we have a total exposure of around 89%, with the corporate representing only 11%. So it will be more interesting to look into how I have grown within the RAM segment. If I take the retail, I have grown by around 16% year-on-year. Agriculture, I have grown by about 13%, and MSME around 7%. So if you look into the growth in the RAM segment, it is decent. As far as the corporate is concerned, I have degrown. That is a cautious decision, because we always feel that we will be having the RAM as our focus area. At the same time, does not mean that I have closed the doors for the corporate. We will be very choosy in selecting the corporates. If I get a good exposure, definitely I will underwrite the corporate exposure. So when I look into the RAM segment growth is decent, as I was giving the breakup for the retail, agriculture, and the MSME. I have given the guidance to the street that during this year, we will be growing overall around 10 to 12%, and we will be able to definitely achieve that.
And FY24, if we can look ahead, what kind of growth projections you are looking at?
It will be too premature, but still I can say that I expect a better 23-24. Overall, the economy will be picking up. So I expect that I may be growing around 15%.
On corporate, you said the corporate book has contracted. So, I mean, what is the strategy on wholesale lending for the bank?
See, the strategy is today I have the RAM and corporate mix of 89 and 12. Probably over the period of next 2 to 3 years, I may be going something like 80-20.
80-20. Okay.
Yes.
So the corporate book will increase slightly.
Will increase.
20%.
Yes. I'll be more concentrating on the mid corporates, keeping in mind the size of the bank and the strength of the bank, where we understand. So we'll be, maybe the large corporates will be very selective to some extent.
Also related to this issue of loan growth, why I am focusing on loan growth so much, because you are sitting on a huge capital adequacy ratio, which is close to 25%. Right. Now there is a cost of capital. How do you plan to deploy the capital optimally?
Okay. Good question. But I will also request you to look into my other parameters. It is true that I am sitting with a huge capital, with capital adequacy ratio of as high as around 24-25%. But I will request you to look into other parameters as far as the shareholders are concerned, how their values are not only protected, but also have enhanced. If you look into my ROA is 2, ROE is 17.14, the net worth consistently increasing quarter after the quarter, EPS is 17.66, and book value is 425. If you look into the PB ratio, probably still there are good scope for the market, right? So the NIM is another area. If you look into, my NIM is 4.5. At the same time, as you rightly said, we are also conscious of optimum deploying of the funds. We are also taking a lot of transformation initiatives or in the process, more particularly on the digital front. Some of the transformations may mature within this fiscal. Some of the transformation may spill over to the next fiscal. These things are expected to give me a boost on my top line. Not only the top line, will also be saving a lot of cost for me, which again will go to my bottom line.
Now coming to the liability side, the deposit growth was almost flat, 3% growth year on year. What would be your strategy to beef up resource mobilization?
See, as far as the liability part is concerned, I was telling that normally, as you were telling that I have huge capital and I'm sitting on that. Similarly, sitting on a huge liabilities without the matching deployment is also not good.
Right.
I am very cost conscious. I look into the deployment and then mobilize. You may be knowing that the recent past there is still a rate war on the deposits.
Right.
Amongst the banks, right? Now, yes. where I require, definitely I will be increasing the deposits. If you look into where I have lost, if I see CASA, in SA I have grown by about 9.5%, and in CA I have grown around 12%. A reasonable growth when I compare with the overall deposit of 3%. That clearly indicates that I have shut down the term deposits. I have not grown in the term deposits to the extent. And that growth may not be very difficult the moment I increase the rate of interest. The ALCO of the bank took a call, maybe last month we revised. Again, the ALCO will be meeting very shortly. They will be deliberating on the further revision, if any required. So we are aware of the market conditions. Based on the requirement for the deployment, we will be definitely mobilizing more deposits.
Sir, it was a pleasure talking to you. Thank you very much for speaking to Business Standard.
Thank you. Thanks a lot.
Krishnan said that total advance growth has been less than 9%, but in agri, growth has been about 13%. It was a conscious decision as we are choosy in selecting corporates, he further highlighted. There's another change coming to the banking sector which will affect many customers. Bank employees are demanding a 5-day work week. In our Banking for You section, experts explain the impact of this move.
Employees of public sector banks have been demanding a 5-day work week for some time now. This was one of their demands for which they were supposed to go on a strike earlier in the week. The strike was deferred. But how will a 5-day work week affect service standards at banks? Will it affect clearinghouse operations in a big way? To understand the implications of a shorter work week in banks, we should appreciate how banking has changed over the last decade or two. The emergence of digital banking has altered how banks acquire and service customers, and branch visits are a thing of the past. State-of-the-art payment systems like the real-time gross settlement, national electronic funds transfer, immediate payment service, and the unified payments interface have vastly reduced the pressure on RBI's clearing house. Given these developments, UFBU's demand for a 5-day working week for bank staff will not materially affect banking operations in the country. A 5-day working week will also reduce the operational costs for banks, not to mention less stress for bank employees. The demand by UFBU for a 5-day week has been a long-standing one and has been reiterated now that talks are on for hammering out the 12th bipartite settlement between the Indian Banks Association and bank unions. This demand was partly met in 2015 when the second and fourth Saturdays in a month were declared holidays for banks. Bank unions now want all Saturdays to be declared holidays. The 5-day week was introduced for union government employees over 3 decades ago during Rajiv Gandhi's tenure as Prime Minister. It was never extended to state-run banks in all these years, even as India Inc. has shifted to a 5-day cycle as it is the case globally. The unions have made a fair demand of IBA and are for daily working hours to be increased by 30 minutes by advancing it in the morning. And the same for customer service hours and non-cash transaction banking. The terms up for discussion are as follows. The revised timings will be from 9:15 a.m. to 4:45 p.m. instead of 9:45 a.m. to 4:45 p.m. And cash transactions are to be carried out between 9:30 a.m. to 1:30 p.m. and 2 p.m. to 3:30 p.m. with non-cash transactions from 3:30 p.m. to 4:45 p.m. Even before the current wage talks, the unions had demanded a 5-day working week during the pandemic. Banking staff were stretched even as they ran health risks. The 24/7, 365-day availability of services like RTGS, NEFT, and IMPS works as insurance against disruption in banking services because of a 5-day work week. Global benchmarks also suggest it may be time for Indian bankers to join their other corporate world peers.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A 5-day working week for bank staff will not materially affect the banking operations in the country. It will reduce the operational cost for banks though. Given the budget was just announced, a discussion on the financial sector in the country is incomplete without that budget. Our consulting editor, Tamal Bandyopadhyay, discusses the budget takeaways and its impact on the financial sector. Hi Tamal, thanks for coming on the show.
Thank you, Ishan.
Now, there's a dichotomy between what the government is projecting for growth and what the economic survey said yesterday. Where do you find yourself in that debate?
No, there's no debate. I mean, the government is more conservative, and rightly so. So, absolutely fine. I mean, I'm with the finance minister. I think it's better to be conservative, and then if you can overachieve, that's a separate story altogether. If you see in the current fiscal year also, in terms of revenue generation, I've seen the tax collection, etc. It has far exceeded what the government had estimated. So it's better to have a conservative estimate and overachieve than promising something or estimating something which we can't achieve. So certainly, I think it's a more realistic assessment by the finance ministry.
The fiscal consolidation roadmap, as I'm to understand, is being strictly adhered to. What is your opinion of that?
No, that's a excellent key takeaway from the budget. Say what happened is the current fiscal year 6.4, the estimated number is being adhered to. That's what they're given the impression. Now it will go down 5.9 by 50 basis point in the next fiscal year, which is 2024, starting April. And the commitment is by 2026, it should come down to 4.5. And Mrs. Sitaraman said that she is committed to do that. I mean, there is a clear glide path, and she is adhering to a fine balancing act between fiscal consolidation and growth. That's how I look at this budget.
Now, market borrowings are at their highest. What do you make of that one? And would it be easier for banks to get out of G-Secs for credit creation, or would this make it more difficult?
Yes, market borrowing is its highest. don't go by the gross, you need to see the net. And but it is in sync with what the market had expected. As you have noticed, after the budget, the 10-year bond yield actually dropped. So that shows the market's comfort with this. So while the borrowing is high, it was within the line of market expectations. And when globally central banks are keen on dialing down the interest rates, I think it will not be, I would not like to say it will be smooth selling, but as of now, I would like to say it will not disrupt the market.
Within the financial sector, let's talk about the KYC process that is being eased. Then we have a National Financial Information Registry that has been created. What would all this mean for the sector?
It's absolutely good for customers. KYC is a big hassle, the entire process. So the finance ministry wants to simplify it and make it uniform. That's one part. This credit registry, actually, I have written about it a few weeks back. It had been an RBI proposal, which was, I thought it was shelved, but I'm happy to see this, of course, under a different name. So the credit registry actually will record all the information, both credit and non-credit, of you, me, and everybody else. So what will happen is this will, the financial sector, be it banks or non-banks, they will be in a better position to appreciate your and mine financial status. So the credit flow will definitely increase. From the bank's perspective, they will be more certain about the quality of assets, the loans which are they giving it. Because this is not only the financial information, it's everybody else, everything else, all information will be gathered. So it's certainly a win-win both for the customer as well as for the banking system.
You've often talked about the middle class and the impact of the budget on it. Now, would you call this a depositor's budget as well, given the schemes and everything that has been launched?
Yeah, I mean, quite a few things been done, which has been long pending, and the tax slabs been restructured, so that you pay lesser tax, and then certain new exemptions being offered for senior citizen. The quantum has been doubled, and the new small savings scheme also have come up for women, which is a fixed interest rate of 7.5. So I think because if you see the small savings scheme, the collection this year is if I'm not mistaken, the first half is almost 10% down compared to the last year. And it is bound to go down because the banks are offering higher rates. So I think, and one of the contributing factors to bridge the fiscal deficit is small savings. Small savings, one, and then divestment is another, and the bulk is government borrowing. So I think keeping all this in mind, and of course the sentiment and the high inflation, etc. So all these things, there are the pockets have been created, which will be by which the government will be able to collect more small savings. Consumers like you and me will have more money in our pocket. So that will also probably bolster bank deposit as well as bank credit, because retail credit will grow. Retail credit, if the consumption takes place, then the retail credit will grow. I mean, people will buy two-wheelers and other things, so personal loans, etc. And the huge hike in capex also ensure the corporate credit. So I don't think banking sector should have anything to complain about.
Perfect. Thanks a lot. Thanks for coming on the show. We hope to talk to you soon again. Thank you. This was the last full budget for this government before the national elections. The target is to bring back the fiscal deficit to FRBM levels. Last week, we asked you a question on the regulations governing the banking entities. We wanted to understand if the RBI should bring some of uniformity in regulations governing the banking sector. 91.9% of the people who replied to our survey believed it should bring some parity to banking sector. This week, we would like to know if you think private sector banks have done enough on financial inclusion. 2 weeks ago, the Finance Ministry asked all banking entities to meet their financial inclusion and social sector scheme targets. The record of the private sector in this regard has been poor. Our polls open on Friday and you can respond on Twitter, Instagram, LinkedIn, Telegram and our website. Private sector bank performance will be better if there are more opportunities from rural areas, which is soon turning into reality as the credit focus shifts. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.